Hey, everybody. Welcome to the What the Wealthy Do podcast, where in 15 minutes, we look at what the wealthy do in order to build their wealth and show you how you can apply those same strategies while you're on your wealth building journey. I am your host, Stephanie Dorsey. I am the CEO and co-founder of Margins Capital. Margins Capital is an investment firm that focuses on providing access to an institutional quality of alternative investments to women and people of color. Today, we are going to continue our series and breaking down different alternative investment asset classes. And today I'm really excited about it because I learned a lot while preparing for this episode. We are going to be focusing on crypto. A lot of us are like, what? And so I wanted to spend some time being able to break it down and explain it to you so that you can make an informed decision when you decide, I ain't doing that, or you are doing it. So this episode today, we're really just going to be talking about the origin and the history and what it actually is and what it is not. And then next week, we'll talk a little bit more about how to think about it from an investment perspective and how the wealthy include it in their investment portfolios and how you can think about it for your investment portfolio. Just a reminder, this podcast is not intended to give financial advice. It is simply intended to give financial education. So let's dive in. First things first, what is crypto? Like, what is it? And what it is digital money. Cryptocurrency is digital money. It's not physical like we have cash. It's not even a digital representation of cash like the money in our bank account. It is literally digital money that lives on what's called the blockchain. And the blockchain is technology that's basically a ledger. And I like to think of it as a big secure spreadsheet. So it's a ledger or spreadsheet that tracks every transaction publicly and with the emphasis on securely. So it tracks it securely and publicly. So think of it like this. Your bank has a record. Basically, your bank has this big old database of all their customers, and they have how much money you got in there, and they keep a record of when you spend money and when money goes out. So it's that. The blockchain is basically that. The difference is it's public and it can't be easily changed or manipulated by any outsider. The technology is created such that all you can do is report to it, but you can't change it. And so it is transparent. It is decentralized. So no government or one particular institution or bank owns it. And that's why you hear folks saying like, oh, wow, this is kind of like it gives the people back its power. It takes the power away from these massive institutions or governments and gives the power back to the people. All right, but here's another question. It's like, so I'm playing two roles today in case you ain't figured it out. But where did it come from? How did it begin? I'm glad you asked. So Bitcoin was literally the first cryptocurrency that was ever created. And its origin story really tells you a lot about why crypto exists in the first place. But before we get into that, I want to make you aware of something that a lot of us aren't aware of, which is finance is, while it's old in terms of, you think about hundreds of years ago when folks were trading before we even had paper money and people were making trades for spices and whatnot. What we understand finance to be today is new and ever changing. Think about it. Women weren't allowed to have credit cards until 1974, which is just a couple years older than me. The 401ks didn't exist until 1978, which is the same year I was born. And then think about, in order to trade stocks, you had to deal specifically with a broker who could decide to work with you or not based on all kinds of other things that I don't even need to name. And that was up until the 1990s. It wasn't until the mid-90s that basically bias was removed from trading. So finance is continuously evolving and innovating. So while crypto seems this big scary thing that's a disruptor, it is a disruptor, but this level of innovation and disruption is actually fairly normal in finance, at least in the last 40 years or so. So let's talk about where it came from. It was born out of the financial crisis of 2008. As you remember, 2008, there were a lot of banks that made some very, very risky investments in terms of buying collateralized debt debt obligations, or basically they were buying pools of mortgages, or basically they were buying pools of debt, but in those debt they had subprime mortgages, or mortgages that were just a little bit risky and probably predatory, and the people that had those mortgages couldn't pay them. So the whole thing was a house of cards, and our markets collapsed as a result. And so this person or group of people named Satoshi Nakamoto, they published this white paper. And this white paper, it was entitled Bitcoin, a peer-to-peer electronic cash system. And so they published it in 2008. And I guess they had enough people that was like, this seems kind of like an interesting idea. So they decided to build the thing. And so what they did in January of 2009, they built what we know to be the first ever blockchain technology, which used cryptography, which is basically just codes and algorithms, so that, and it's super layered, so it made it super secure. And they published the first digital ledger, and they called it the blockchain. And then that white paper that they published in 2008 outlined new kind of money, a digital cash that didn't need a bank, it didn't need government, and there didn't need any middlemen. And so that individuals could send money directly to one another using cryptography and a shared digital ledger called a blockchain. And so then I guess the paper was well received. In 2009, Satoshi launched the Bitcoin blockchain, and they mined their very first block called the Genesis block. And inside it, they left a hidden message that said, the Times 03/January/2009, Chancellor on brink of second bailout for banks. And this was a statement. What they were saying was Bitcoin was not just technology, it was a protest against a broken financial and government system. And so a few days later, Satoshi made its first ever Bitcoin payment to a computer scientist named Hal Finney. And that was the moment digital money became a thing. It became real. And so Bitcoin solved a huge problem that had stumped people for years, which is how to create digital money that couldn't be copied or counterfeited. So that's important. Think about it. There are people still trying to counterfeit money today, counterfeiting gold even. But this right now, digital currency is not able to be counterfeited. And because of the layers and layers of algorithm and cryptography that's used to protect the blockchain, so that every transaction that is uploaded to the blockchain is secure. And so Satoshi's solution keeps every transaction public, time-stamped, and verified by a network of computers, which is basically the miners. When people talk about mining Bitcoin, that's the network of computers that are mining the Bitcoin. That meant that no bank needed to say, yes, this transaction is legit or not, because the network itself has confirmed it. The blockchain, which is the network, has confirmed that this transaction is legit. And so Bitcoin became the blueprint for all the other coins that came after it. So Ethereum, stablecoins, NFTs, all of those things trace their roots back to that white paper in 2008. So why is Bitcoin limited to 21 million coins? So Bitcoin's scarcity was intentional. It was built by design. Satoshi wanted to create digital money that behaved like gold. It was finite and it was resistant to inflation. And so there will only ever be 21 million Bitcoin that is out there in the world. And this number is hard coded into the system. So new Bitcoin is created through what is referred to as mining. But every 4 years, the amount of new Bitcoin entering circulation, it gets cut in half, an event called halving. So in 2009, miners earned 50 Bitcoin per block. And in 2012, that dropped to 25, and then 12 and a half, and then 6.25. And then this gradual slowdown will continue to about 2140, which is when all 21 million Bitcoin should have been mined. The design ensures that Bitcoin becomes scarcer over time. And that scarcity is a big part of why Bitcoin is often referred to as digital gold. It's also a reason why the price can continue to go up as it has over time. And while 21 million might sound like a very random number, it wasn't. Satoshi chose this number strategically because they wanted to balance scarcity and divisibility. And so each Bitcoin can be divided into 100 million smaller units. And so there's plenty of room for microtransactions to happen even as the price grows. So I was wondering, like, okay, so do all cryptocurrencies have the same level of scarcity. And no, they don't. Every cryptocurrency has its own, what they call tokenomics. Basically, it's its own economic DNA. And here's how it breaks down. So Bitcoin has the scarcity included. Like I mentioned, it's capped at 21 million. Ethereum doesn't have a hard limit. It's inflationary by design. But since a portion of transaction fees are burned, it can become deflationary, meaning it can lose value over time. And then you have some stable coins that there's no scarcity related to that because they are going to be tied to actual money, real world currency, like the US dollar, and it's going to be minted as necessary, very similar to the US dollar. Altcoins, it depends. Some are capped like Bitcoins, others like Dogecoin, which is an absolute meme coin, have an unlimited supply. So scarcity is not universal. It's a design choice. Bitcoin's model was about preserving value, and others prioritize flexibility, utility, or even accessibility. All right, so is crypto a real investment or is it just hype? And the answer to that is it's both. So crypto can be a legitimate investment. It legit can. It's highly volatile, and the wealthy don't see it as a get rich quick scheme, and they see it as a long-term play in an emerging technology. The people that invest, that are sound investors, that invest in crypto, they do so because they believe in its staying power. They believe in it being the next evolution of finance and of currency. They know that Bitcoin and Ethereum and other blockchain-based assets are building blocks for the future of finance and real estate and art and any type of investing. And so they approach it differently. They treat crypto as a portion of their portfolio. They treat it as an alternative asset. It's not the whole thing. They invest 1 to 5% of their net worth in it, max, and they use it as a way to diversify their investments. They understand that it's high risk, but they also understand that it is a high reward space, which is what alternatives are. So another question, what are stable coins and should I invest in them? A stable coin is a type of cryptocurrency that's designed to keep a steady value. So it's usually being pegged to something that is stable and or something that is physical, like the US dollar or the euro. So a stable coin like the USDC or Tether is supposed to always equal to $1 US. Now, the purpose of the stable coin is to give investors the benefits of crypto, like fast, borderless transactions without the wild price swings, without the volatility. And they're used for trading, transferring money across borders, or parking cash between investments. This could be really useful when you're traveling. So think of it as it's the new traveler's checks, or like I think about when I did Peace Corps and I was living in Ecuador. Ecuador is a very stable place, but assume I was living in a very unstable place where we did not necessarily trust the institutions or the banks that existed. You could have this stable coin, and this type of digital currency could be very useful to navigate when you're living in a place that is less stable. So I'm thinking of a developing country. So one thing though to note, stable coins aren't really investable assets. They're just tools. So don't think of it as like Bitcoin or something like that that's going to appreciate in value. It's literally just a way to have your dollars digital in a way that obviously using your Wells Fargo or whatever account would not work. But if you have a stable coin in a place that, well, Wells Fargo didn't exist or Cash App didn't exist, you would be able to transact with someone because theoretically they would have a ledger and they would be able to receive your digital asset payment. Is crypto safe? Crypto is as safe as your understanding of it. The technology itself, the blockchain, it is safe. It's incredibly secure. But where people get kind of jacked up is the scams, the hacks, the emotional investing. I've done that. I'll talk to you a little bit about that. So this is how you should be looking at it. Don't chase the hype, the meme coins. Don't fall for the double your money promises. Research the projects, the coins that you think you want to invest in, the technology that's supporting those coins, and make an informed decision about how this particular investment or cryptocurrency or coin fits into your overall investment thesis. And just remember, if it sounds too good to be true, it probably is. So how do I rationalize the fact that Warren Buffett, who is one of America's most successful investors, thinks it's just gambling? And if that's the case, like, why should I even invest in crypto? Listen, Warren Buffett is one of the greatest investors of all time. He's definitely going to be on that Mount Rushmore in terms of American investors. But he's also 94, and he built his empire on a world that looks very different today than it did when he first got into investing and when he built the mass majority of his wealth. Some of the fundamentals are the same, but the how is going to look wildly different than what it looked like for him. And just understand, his investment philosophy is built on value investing, like owning businesses that generate cash flow and have tangible assets. Like, that's it. And so from that lens, crypto does look like gambling. There is no physical asset. There is no quarterly earnings report. There are no board of directors. Here's what you should know. Every major technological shift, be it railroads, the internet, social media, and now cryptocurrency, started out looking like a gamble. It looked crazy. So is crypto gambling? If you're just buying coins because of hype or social media, then it absolutely is. But if you understand what you're investing in, the technology beneath it, the utility, the evolution of decentralized finance, then it's not gambling. It's really just early adoption. So the wealthy, or the folks that are investing, not gambling, not speculating, in crypto, are doing so because they believe it will be the next financial system. And they're not necessarily betting on coins, they're betting on the innovation of the system. So this other question is, if crypto is not backed by any real assets, like, why should I invest in it? What makes it real? And here's the thing, the US dollar is also not backed by any real assets. It's backed by a mutual understanding, because it used to be backed by gold and silver, but it hasn't been backed by gold and silver since 1971. Now it just exists because we have a mutual understanding that it is valuable. There's trust that it is backed by the US government and it has value. And crypto is similar. It is backed by code, by math, by community trust. There are millions of people that think this thing has value, and we believe in it. And so it's very similar to the US dollar in that regard. But unlike the US dollar, the scarcity of Bitcoin in particular, there only ever being 21 million Bitcoin, is also what adds to the value of the Bitcoin. So the true wealth, where people really see the value, and let's think about Bitcoin or any of the coins, the true value is in the blockchain technology itself, in the fact that the infrastructure for how the data, the contracts, and the money will move in the future, that is faster, cheaper, more transparent, more secure than what we've had for the last couple hundred years in terms of banks and the government. That is what the wealthy is investing in. And if you can get behind that and believe in that, then perhaps crypto is something that you should consider investing into. Okay. That was a lot. All right. Today we talked about the origins of Bitcoin and cryptocurrency, and I tried to answer some of the big questions that a lot of us have about what is this thing and why should I give a about it and what does it mean. Hopefully this was very helpful. Next week we're going to talk about, get down to the brass tacks about like how the wealthy is using these investments in their portfolio and how you can start to think about whether or not you should be adding them and how you can add them to your investment portfolio. Hopefully you found this episode very, very helpful. And if you did, please share it with a friend. Also, don't forget to like, comment, subscribe to wherever you like to get your podcast, be it Apple, YouTube, or Spotify. And I look forward to seeing you next week. Bye.